Reaching your first $100,000 is a massive financial milestone. It's often the hardest part of the wealth-building journey, as that initial capital takes immense discipline, saving, and patience to accumulate. Most people who reach this point have been intensely focused on one thing: accumulation. They've lived frugally, increased their income, and invested consistently. But here's the thing. Once you cross that magical 100K threshold, the rules of the game suddenly begin to change. The focus shifts from pure accumulation to smart preservation and strategic growth. The wealthy understand this shift, and they follow a few simple yet powerful rules to ensure their money not only stays put, but continues to work for them, effectively making their wealth compound faster and faster. This isn't about complex financial jargon or secret offshore accounts. It's about a change in mindset and a few core principles that you can apply, starting today. Let's break down the simple portfolio rules wealthy people follow after 100K to stay rich. The first rule wealthy people embrace is a simple but critical mindset shift, understanding that their money needs to work harder than they do. When you have a smaller amount, your personal savings rate and income are the main drivers of growth. After 100K, the power of compound interest truly starts to take off. The annual returns on a larger sum become substantial in absolute dollars. For example, a 7% return on $10,000 is $700, but on $100,000, it's $7,000 a year, and on $200,000, it's $14,000. This means your investment strategy needs to be reliable enough to capture that growth without unnecessary risks. The goal is to build a portfolio that can eventually generate enough passive income to cover your living expenses, a point often referred to as the crossover point. This moves you from trading time for money to a place where your capital is generating income around the clock, whether you're working, on vacation, or even sleeping. This isn't just about retiring early. It's about having options and control over your time. It's about building a sustainable financial engine that doesn't rely solely on your active labor. This freedom is the ultimate goal of the wealthy, and achieving it starts with recognizing that your money is now an employee that needs clear instructions and a secure work environment. The second core rule is a strong adherence to rigorous long-term diversification. The classic investing mantra of "don't put all your eggs in one basket" becomes even more critical when you have a significant sum to protect. While building up to 100K, you might have concentrated your investments in a high-growth stock or a specific sector that you understood well. That high-risk tolerance approach worked for building wealth, but now you have wealth to preserve. Wealthy individuals diversify beyond just stocks and bonds. They look at a broad range of assets including real estate, commodities like gold or silver bullion, and even alternative investments such as private equity or fine art, depending on their net worth and expertise. This comprehensive diversification across different asset classes, industries, and geographical regions is a key defensive strategy against market volatility or a downturn in any single area. A crucial element of this diversification involves balancing risk and reward. With a larger sum, a significant loss is much more impactful than when your portfolio was smaller. The wealthy shift their focus to asymmetrical opportunities, investments with a low downside risk but substantial upside potential. This might involve having a solid foundation in low-cost, diversified index funds that track broad markets like the S&P 500, a strategy even recommended by Warren Buffett for most investors, which makes up a large portion of the portfolio, sometimes 90%. The remaining portion might be allocated to safer, income-generating assets like short-term government bonds or high-yield savings accounts to provide stability and liquidity. This balanced approach ensures steady growth potential while having buffers in place for unforeseen emergencies or market crashes, preventing a single event from derailing a lifetime of saving. The key here is not predicting the future, but building a portfolio that can weather any storm. It's about robustness over trying to chase the single hottest stock tip of the day. Rule number 3 is the strategic use of good debt versus bad debt. Most people see all debt as a trap. The wealthy see debt as a powerful tool for leverage, using other people's money to acquire appreciating or income-producing assets. They understand the distinction. Bad debt is for consumption. Credit cards for daily expenses, or loans for a new car that immediately appreciates in value. Good debt, on the other hand, is used to make more money. Think of a mortgage on a rental property, where the rent covers the loan payments and the property value increases over time, or a business loan to expand an income-generating venture. The key is smart leverage, using low-cost, fixed-rate loans to build equity and generate cash flow. This strategy, however, requires careful management, as poorly planned borrowing can lead to disaster during economic downturns, which is why a strong emergency fund and risk management plan are always in place. Leveraging debt effectively means minimizing your own capital outlay while maximizing potential returns. It's a calculated risk that separates those who remain stagnant from those who can scale their net worth efficiently and effectively. Perhaps the most challenging rule for many is avoiding the trap of lifestyle creep and maintaining discipline. It's incredibly tempting to upgrade every aspect of your life the moment your net worth hits a new milestone. A bigger house, luxury cars, expensive dinners, and fancy vacations can quickly eat into your savings rate. This is lifestyle inflation in action, and it's a sure path back to financial stress. Wealthy people, even with millions, often live surprisingly modest lives, a concept known as stealth wealth. They measure their success by their net worth, not their paycheck or visible spending habits. They continue to live below their means, funneling excess cash into investments. This discipline and patience allow compound interest to work its magic over decades, not just a few years. The goal is financial independence, not impressing others with status symbols that often lose value. This discipline is the engine that keeps the wealth machine running smoothly. Without it, all the smart investing strategies in the world won't prevent the erosion of your capital through unnecessary spending. It's about prioritizing financial freedom over instant gratification. Finally, the wealthy prioritize investing in themselves and their network. The learning journey doesn't stop after hitting 100K. It intensifies. They continually educate themselves on finance, market trends, and new investment opportunities. They read books, follow trusted financial news, and learn from both their successes and mistakes. Just as importantly, they surround themselves with a network of financially successful individuals and professionals, including fee-only financial advisors, tax experts, and legal counsel. This personal board of directors provides valuable insights, opportunities, and accountability that accelerate financial growth beyond what one person could achieve alone. Building wealth is a long-term game of stamina, continuous learning, and smart, intentional decisions. This pursuit of knowledge and connection is a powerful accelerant to wealth creation. They know they don't have all the answers, so they outsource expertise and leverage the wisdom of others to make informed decisions and avoid common pitfalls. So there you have it, a shift from pure accumulation to strategic preservation, a focus on diversification across different assets, smart use of leverage, avoiding lifestyle creep, and continuous self-improvement. These are the simple, powerful rules that the wealthy follow after reaching that first major milestone. Reaching 100K is just the beginning. Applying these rules is how you ensure that wealth is not only kept, but grown into lasting financial freedom for generations to come. By internalizing these rules, you stop chasing money and start architecting it. You transition from being a participant in the economy to being an owner of it. The journey beyond 100K is where true wealth is not found in a number, but in the unshakable security, the abundant options, and the profound peace of mind that comes from knowing your financial fortress is built to last.